Alrighty, folks. A lot of you have been asking me, Michael, when are we going to see mortgage rates with a 5 handle? Well, I've got great news for you, folks. You're going to hear about today how you might be able to get DSCR loans with a 5 handle. And yes, I said, and portfolio loans with a 5 handle. We've got the one and only Josh from Lending One. How you doing, buddy?
Man, I'm doing great. How are you? It's been a couple of minutes since we've done this, but excited to be back. Thanks for bringing me back on again.
Oh, I love having you on the channel. I have gotten, first off, thank you for being a part of the One Rental at a Time event in Vegas. I have heard nothing but great news from people who have used your service to date. Lots of them are already referring more and more people to you. So Lending One is clearly struck a nerve with the One Rental at a Time fan, and I expect a lot more phone calls based on what we're about to go through.
Yeah, absolutely. So the event, let me just say, was amazing. Love being a part of that. Really cool atmosphere. I'll tell you the thing that I was really impressed by was the variety of the different types of investors that were involved. We found people that were just getting into it, but we talked to people that had 50, 100 or more units in their portfolio. I mean, there's a lot of variety in the one rental family, and so that was really cool to see.
Yeah, it's something. It's fun to see this build. We've had people that started with 0 now have 30. We've got other people starting now, so it is a wonderful community to be a part of, and I smile each and every day. But let's talk about the topic at hand.
Yeah.
Obviously, Lending One, a lender. Shocking, great title, by the way, great name, Lending One. We were talking off camera. You could get DSCR loans today with a 5 handle without stretching. And you could also do portfolio loans. So let's break down DSCR loans first, and then we'll define a portfolio loan just so we'll make sure we're on the same page. But we're talking rates in the 5. I've said for a while now, rates in the 5 changes real estate.
Yeah.
So why don't you go ahead and give your little caveats and all of this? How do we get there?
Yeah. So great question. So first, let's kind of talk about the difference a little bit between a standard DSCR loan and a portfolio loan. I think it's probably a good place to start, right?
Yep.
So a DSCR loan, when we're talking about it as a single asset, we're looking at a single property being a single family detached, a condo, townhouse, duplex, triplex, quadplex. So that's kind of what we're talking about. One unit, whether there's multiple doors in that unit, but one unit.
Got it.
So the DSCR loan is just for qualification purposes, we are an asset-based lender. So for the people out there that say, hey, I went to my bank and I'm a little bit stretched on a DTI loan with my bank or my credit union, we don't care about that. We don't look at W-2 income. We're not checking tax returns. That doesn't matter to us because we're loaning based on the asset and will the asset perform. So what DSCR stands for those who are not familiar with this loan type, it's a debt service coverage ratio. And so the difference between that and a DTI qualified loan that typically happens with a bank or a credit union is they're using your debt to income. So they're worried about your personal ability to repay that loan. What we're more focused on is whether or not the asset you're buying is going to perform to be able to cover its own obligations. So simply put, if you're looking for a DSCR loan, which by the way, we go down to as little as a 1x coverage ratio. So if you have a good credit, typically is going to be 720 or better, and you come to us and you can bring us a property that will rent for, let's just say hypothetically, $2,000 a month. If the principal, interest, taxes, and insurance on that are $2,000 a month, that $2,000 rent over principal, interest, tax, and insurance, $2,000, that's a 1x coverage ratio. That's all we need to be able to qualify that loan. Now, look, you are smart enough, I'm smart enough to know we would advise somebody, give yourself a little more margin, right? You might wind up with a HVAC problem, and so you don't want to be that tight on it. But if you've got good credit, we're going to loan on that asset. So that's a standard DSCR loan. We're looking to make sure that the rent you can get on that 30-year product is going to cover the mortgage effectively, right? And so on the portfolio side, this is a product where you can take multiples either as a new purchase. So a lot of people, now we're seeing a lot of position. People got a lot of tied up equity they're wanting to get out. And so you're seeing a lot of portfolios move. So you as an investor might know another investor who's selling a portfolio of say 3, 5, 10 properties at once.
Yes.
And what we can do is we can group those together into one loan. So it's one origination fee, one loan, one payment. You get a little bit of a reduction even in the interest rate because you're doing a portfolio loan. And we can do those on new purchases and on refis. And so new purchase and refis both apply to the standard DSCR single asset as well as the portfolio loan. So we'll start there, kind of defining that.
So many things. So I want to make sure the audience realizes what they have at their disposal, right? So again, we'll start with just DSCR and go to portfolio next. DSCR loans are non-traditional mortgages, right? This is not something you're going to get from, it's not a Fannie Freddie loan. Fair?
Fair.
Right.
Correct.
Right. These funds typically Wall Street kind of funded or backed or sold on the market. It's a alternative lending environment. Is that fair?
Absolutely. So the primary difference is us as private lenders, we're not selling agency backed paper. So we're the ones that are originating these with our own money. So it's not guaranteed by the federal government. So that is one of the primary differences. And the second thing that I would point out for the people that are really looking to grow as an investor, one of the things that you're going to hear when you go to your bank or your credit union is, hey, you can't close this loan in the name of your LLC or your entity, where we are what's called a business purpose only lender. And so what that means is we only close a loan in the name of your LLC, trust, corporation, etc., because we want to make sure. Now, every loan has a personal guarantor attached to it. So if you're a partner, the owner of that LLC, we're going to qualify that loan based off of your credit, but the actual closing is going to happen in the name of the entity. And the value that brings to an investor is typically that loan is not going to be reported on unless you go into default. And so that means for you, if you need to go buy a primary home or a car or use your own credit, you don't have the weight of all of those mortgages weighing you down.
Yeah, that is such a subtle but very important difference that people need to understand. The ability to close in the LLC, the ability to not impair your DTI for a home purchase or a car or something else is very, very powerful. Typically, there are some caveats or restrictions. Probably the one I hear about most often on DSCR loans are loan limits. Is there a minimum? Do you want to be over 50, over 75, over 100? Where does that kind of bar sit?
Great question. We do get that a lot, and obviously, your audience spans a very wide geographic base, and so you see a lot of people that might find a $20,000 or $30,000 property they want to find. That's fantastic. We love it for those guys. Unfortunately,
put that on your credit card, folks. Put it on your credit card.
Yeah. So we do have. We're going to typically evaluate it based off of appraised value. So we're looking for a minimum appraised value of around 100,000. That's typically the target of what we're looking for.
Okay. So I'll just ask it. So if you had a property worth 100 grand and somebody said, hey, I wanted to do a 50% LTV, that would be a loan you would look at.
It's something we would look at for sure. Yeah.
Yeah. It would probably feel better just based on the way you responded if they wanted 75 grand.
Yeah, so that's typically, we're going to target that 75 grand as an average minimum. The good thing with us, though, is we have the ability, because again, it's our money, right? So you call us and talk to us, and let's talk through what we may be able to do for you. Typically, we're targeting minimums around 100 appraised, 75 on the loan, but we certainly look at everything that comes to us.
Well, I don't know. You probably know this, but for the audience, it's really interesting that you go to that level, because a lot of DSCR lenders over the last 6 months have actually raised their limits. They don't want to touch loans under 150K.
Yeah, well, so part of the reason for that, though, is a lot of people don't have the opportunity to play in the size of sandbox that we do. And so because of our breadth, because of our depth of experience, because of the capital partners that we have that we work with, we have access to different products in different varieties. And we'll talk about one here in just a second with our interest only option. We've got very unique products that investors, if you've got an investor that's buying an investment property, period, specifically in the single family space, there's almost nothing we can't help with.
Well, that's the key. I think a lot of people let's just give them a little taste. Let's talk about the IO stuff or interest only, because I think really what we need people to do is realize that Lending One has lots of options that we can't possibly cover in a 15-minute phone call or a 50-minute interview, which we'll get to in a minute. But tell us about the IO options.
Yeah. So we have on both the single asset DSCR loan and on our portfolio loan, we have an interest only product. And so what this looks like is it's really unique. So it's still a 30-year fixed rate loan, but the first 10 years is going to be interest only. And
Okay.
then it turns into a 20-year amortization on the back end. And here's the reason for that.
Yep.
The majority of the people that we have worked with over years, they're either going to sell or refi any investment property they buy. Because I mean, look, you want to get cash out, right? You're building equity. Yep. That's part of the name of the game. And so within 5 to 7 years, on average, you're either going to sell that property or refi it anyway. And it's incredibly useful for people that are in markets right now that are struggling to find properties that are cash flowing, but in the market that's appreciating well, they can take an interest only product. And over that 10 years, they won't get the benefit of the principal pay down. However, they're going to be cash flowing at a higher rate because they're paying interest only instead of the additional principal. So they're putting additional cash in their pocket during that first 10-year terms, and they take the benefit of the fixed rate so that if they want to hold it as it turns into that 20-year AM, then they're welcome to do that as well with no penalty, no change.
Yeah, the key to that is the owner, the person holding the loan, they know their rate with certainty. It doesn't change at the 10-year mark. It goes from, I'm just going to make numbers up, a 6% interest only into a 6% full AM 20-year loan
right
at that pivot point. So again, certainty is valuable because when you have certainty, you can make decisions. Yeah. Does it make sense to roll into a 20-year, or have rates changed dramatically and it's time to do a rate and term refi? Those would be options to have at the 10-year mark.
Right. Yeah. 100%.
Yeah. So also you've said a couple of times now, residential. Does this mean you have do you max out on fourplexes, or do you go to 10 units, or where does or is there a threshold?
So for us, there is a threshold. So we do, it's strictly 1 to 4 units. So anything that's parceled. Now I want to be clear on this. Anything that's parceled at 5 units or more, we won't operate within. So there's no maximum to the number of units. So if in terms of if it's a 1 to 4, you can bring us 10 duplexes, bring us 100, bring us 1,000 duplexes. That's all the same to us. It's just if it's parceled as a multifamily, a 20 unit complex, that sort of thing, we don't operate in that.
Yeah, again, staying in your lane, doing what you do and doing it well is extremely valuable. The commercial and residential game is different. And I actually appreciate a lender who's willing to call their shots and say, no, we don't try to be all things to all people.
Yeah. And the benefit for us is it allows us to go quicker, faster, be more adaptive in our space because we're not having to play in a lot of different lanes. We can stay in our lane and be as effective as we possibly can be.
Oh, absolutely. Well, now let's switch gears to our portfolio loan, because one of the things that I know is coming is the opportunity to buy portfolios. In fact, one of the best deals I did in the last 4 or 5 years was a 14-unit portfolio. It was 2 fourplexes, a triplex, and 3 single-family homes.
Yeah,
that would be, something you would do. These are coming. There's lots of tired landlords, lots of frustrated folks, a lot of people that just want to move on. In my case, I got seller financing with 10% down, 5% interest only. It works just fine. But, maybe, if this gentleman happens to pass on, maybe the kids will come to me and say, hey, can you refi us out? We'll give you a discount on the note or something. Yeah. So understanding options with the portfolio loan would be helpful for my audience, but also helpful for me. So tell me more about that.
Yeah, so there's 2 ways to look at the portfolio. One is on the new purchase. So we'll go up to 80% leverage on a new purchase portfolio. So if the same instance you said 14 units, we love stuff like that. We do it every day. We're probably the biggest in the country that does this. And so you bring us a portfolio like that, we put it in a new purchase, we'll go up to 80% leverage on it. We also do portfolio refis. So a lot of the times what you see is somebody that's been aggregating properties over the course of the last 7, 8, 10 years, and they're going to have varying degrees of equity and various rates attached to those individual loans. What we can do is we can come in, let's say that you've got 10 that you've aggregated over the last decade. We can take that entire group and we can take properties that you have that have no note on them, properties that have various degrees of, principal payoff still required, we can group those in and we can do a cash out refi on those to where we put them all under one note, one origination fee, one loan, one payment, make it really, really simple. And the cool thing about it too is for a lot of your investors that are really savvy is we can do this in multiple markets. So if you're looking at, if you've got 3 properties in Cincinnati, 3 in Oklahoma City, 2 in LA, and 3 in Denver, we can take all of those and put them into one product. So
I have never, ever heard that. I've heard plenty of people talk portfolio loans, but the caveat to them is they got to be in the same city, the same state. You're telling me I could be in 5 different states and still get the flexibility of this?
the flexibility we have as a lender is absolutely enormous. Yes.
That is unique. That is sexy. Because I know lots of people who do out of state or out of area investing, and a lot of them are asking for that kind of one-stop solution. So you talked about purchase up to 80%. I'm guessing refi might be 70 or 75.
Yeah, spot on, 75%. So we'll go up to 75% leverage. There's no maximum to how much money you can pull out of a cash out refi, though. We don't cap that. So you
cap it at the one DSCR.
At the one DSCR, that's right. So it's got to still be able to perform at a 1 times coverage ratio on the DSCR. Now, here's the cool thing about the portfolio is our portfolio, what we're looking at is a blend. So let's say that you've got 10 properties and you've got 2 underperforming properties that by themselves might not qualify for that 1 times. They might perform at a 0.8, right? What we're looking at is the aggregate of the portfolio. Does the entire portfolio equal a 1 times? Any individual property within that portfolio can be underperforming so long as the entire portfolio covers by at least 1 time.
Great. The last question about portfolio loans, and again, I've heard them handled lots of different ways. Let's say somebody does a portfolio loan, again, 10 properties, and let's say something changes in 4 years, and they want to sell one of those. Is this hey, you got to refi us out 9 of them and sell it, or is there some kind of process to peel one off and sell it? I have no idea.
Yep. So we peel one off. So the way that it works is for us, you'll pay off the principal payment. And then there's a certain amount, and forgive me for not having it off the top of my head, but there's a certain percentage, a very small amount that is added on top of that to go towards principal pay down for the entire portfolio.
Gotcha.
So say it's 10% or 20%, and that one property was $100,000. That payoff will be $100,000 plus the 10% or 20%, whatever it is. But that amount goes towards
to the pile
to even out the balance portfolio.
That is, again, all right. Lending One is really proving to be investor friendly, because lots of lenders would look at that scenario, and I know several of them. It's like, so sorry, you're locked in. You got to refi us out, right? A whole new thing, but we'll give you a break on origination or whatever. What you're saying is no. We understand. Again, back to your point, we got to talk to you. We got to know your plan. We got to understand. I think this makes a lot of sense. Where should there's just so much here. Where should we send One Rental at a Time fans? Because I know we've got them thinking. How do you want them to reach out? What are we doing?
Yeah. So let's talk about before we close up. Let me give them some information. So I'm gonna give you 2 things. So I'm gonna give you a phone number. All right. So the number you can call, and this line specifically set up for our One Rental at a Time family. So they can call 866-703-5875. Again, that's 866-703-5875. So they can call that number, or we've also set up a dedicated loan advisor to the One Rental at a Time family. So if you call, you're not going to be thrown into a random queue. You're going to go directly to my guy, Scott Wolf. And so you can reach him at swolf, yes, like the animal, swolf, SWOLF at lendingone.com. So swolf at lendingone.com, or call 866-703-5875. And then I'm sure we've got a link for you as well that I'm sure you'll be able to put in the notes of the video. And so, they can reach out to us and we'll make sure that we get them good and taken care of for sure.
Very, very cool. Well, let me talk about Wolf one more time. And again, it's just WOLF, correct? There's no silent E.
So it's right. So it's Scott Wolf is his name, and that's swolf at lendingone.com, just like it sounds.
swolf@lendingone.com. Folks, again, I would just take out this phone number, 866-703-5875. If you have questions, take the bull by the horn, reach out, pick up the phone, call them, see what's going on. I appreciate you. This has been a lot of fun, Josh. Lending One offers so much flexibility, is focused on the investor. But really, you got to talk to them. You got to understand what they're trying to do, see what the plan is. And yeah, this has been a lot of fun. I appreciate you.
All right. Thanks. Appreciate you having me.
You got it.